Really no resistance on silver at this point going forward, other than the what I call the idiot highs that occurred at 50 back in 1980 and 50 again in 2011, 10, early 2011. But those highs, remember, decades ago. And if you factor in the decay in the money unit, which is to say it increases in supply about 90% every decade, okay? So it's the real buying power. If you took silver to a price level that matched those highs in terms of real dollar value, silver would probably be $200, okay? Now, I'm not predicting a high. I did have predicted, however, that in this thrust that we're in now, that commenced in June, actually, when it came up to 34 again, and then finally blew through the price highs at 35. There were two highs there, October last year and March of this year. And then you got up to 39, and right now we're 37 and a half zone. I've said this before repeatedly, and all I'm saying is not a prediction, because I think you'd go much higher than this. But if you go back and look on a logarithmic scale chart to when gold was legalized by our government in 1975, there have been two massive bull markets that were eightfold gains, bear low to bull high. Well, if we had an eightfold gain, our bear low was $1,050. That means $8,400 to have an eightfold move. And all you're doing then is replicating what you've already done twice in the last 50 years under conditions that aren't nearly as dramatic as the conditions that are building now in global markets and in the implosion of the U.S. bubble market, stock market. Once that starts to get unfold more clearly to the average investor, that's when gold goes berserk. It's been behaving as a great alternative to the stock market already, going back a year, 3 years, 5 years, 10 years, and certainly 25 years. And yet that's not a headline story on Fox Business News or CNBC. Instead, they're focused on what's NVIDIA doing, etc. So that's the big game. Really no resistance on silver at this point going forward, other than what I call the idiot highs that occurred at 50 back in 1980 and 50 again in 2011, 10, early 2011. But those highs, remember, decades ago. And if you factor in the decay in the money unit, which is to say it increases in supply about 90% every decade, okay? So it's the real buying power. If you took silver to a price level that matched those highs in terms of real dollar value, silver would probably be $200, okay? Now, I'm not predicting a high. I did have predicted, however, that in this thrust that we're in now, that commenced in June, actually, when it came up to 34 again, and then finally blew through the price highs at 35. There were two highs there, October last year and March of this year. And then you got up to 39, and right now we're 37 and a half zone.
Silver's story is one of long consolidation and quiet building energy. Despite hitting nominal highs near $49 in 2011, inflation-adjusted figures show current prices are significantly lower. Analysts suggest silver now forms a massive cup and handle setup, a potential blockbuster breakout in the making. Once industrial tension and inflation converge, silver may be primed for a dramatic surge. Copper, a cornerstone of infrastructure and energy, is riding a sustained bull trend. Prices recently regained momentum around $4.38 per pound, appearing roughly 11% higher year over year despite short-term volatility and up significantly since 2020. Forecasts suggest targets between $5.27 and $6.50 as demand tightens. Even speculative models point toward dramatic further upside, possibly $8 or more.
This move should take you probably to over 50. I'm guessing between 60 and 70, not just a wild guess, by the way, between now and year end. In other words, take out those old idiot highs that everybody seems to think are meaningful. Buy enough to where everybody says, well, golly, we're in never land here. Where are we going? And suddenly you wake up the population, the investor population, to a market that's already been doing quite well for the last, decade plus. And if you look at a monthly close only chart of silver net price, just the monthly closes, forgetting, and go back to 1980, for example, if you can go back that far. The highest monthly close back then was $34.50. It traded up to 50, but that was phantom. The highest monthly close was 34.50. Yeah, you see it there.
Yep.
And just short of 50 back in the 2011 peak. So those highs were really phantom. In other words, you didn't even stay up there very long. It was gaseous. And so when you made the high, you collapsed. You didn't fool around. The next month after the new high, wham, they got hit. Those highs are coming out. And I don't think we'll pause until we're credibly beyond those. And I suspect that'll be by the end of this year. And that's just this thrust. I'm not talking about the end of the bull market. In fact, my view of the end of the bull market is there won't be an end as such. I think what's going to happen is the fundamentals in play and the macro technicals, in fact, argue that this bull trend in monetary metals is likely going to end up with them becoming institutionalized. In other words, this government, that government, finally more and more saying, hey, this fiat currency game, unbacked currency game hasn't really been working. It's ultimately been a negative. It creates boom bust cycles. Let's just go back to, gold or silver as monetary metal. And I think at some price level, I don't know, gold may be 10,000, 20,000, I have no idea, but some level, when enough of these dynamics come into play, and I don't mean the gold price dynamics, but I'm talking about world economic situation, turmoil, a sense of uncertainty on the part of public, a sense of panic on the part of the public. And it doesn't take much to get you there, and inflict pain on the public, in other words, to where they say, we need something different. And I think we're going to have monetary metals institutionalized once again after this next crisis, which is yet to unfold in the eyes of most people.
Recent U.S. trade policy has added volatility to copper's story. Tariffs or exemptions spark sharp swings. For example, copper plunged 22% in a single session after semi-finished imports were targeted, despite refined copper being spared. Supply-demand fundamentals remain strong, but headline surprises can inject knee-jerk reactions, offering both challenges and opportunities.
That's a crisis that was not front and center in the 2008-2009 drop, for example, or the 2000-2002 drop. Now it's front and center because government debt is a crisis level. And you'll notice that right now we're getting a nice rally in T-bonds, but it's still in the lower quadrant of the past 3-year price range, or the upper quadrant of the last 3 years yield range. I'm talking long-term debt, 30-year bonds, for example. So it's not acting as an alternative to the stock market, which was the case in 2000 to 2002. If you owned gold or T-bonds, you did well. Or 2007 to 9, if you owned T-bonds or gold, you did well. They went up nicely in percent gain. Yeah, there were some wiggles in there, sharp ones, but they went up while the stock market went down. Right now, the only thing going up versus the stock market is the gold market. T-bonds have not really engaged. They might. But as Jamie Dimon and others have pointed out, fundamentally, this crisis, the government debt crisis, is, this time is probably not avoidable. This time it'll become front and center. And so we're questionable about whether the current rally in T-bonds, the drop in yields we've seen over the last several days, for example, is sustainable. There's some levels below the T-bond market in price that if you go down there again, you're going to get a mini panic in the bonds. Right now, you're avoiding that. But they're really not an investment alternative, as they used to be to the stock market. So those asset managers out there who are getting a little bit antsy about the stock market because it's up, down, but confusing, they're not moving money into the bond market because it's questionable.
Mm-hmm.
Whereas the money's going into gold and Newmont lately.
Newmont, yeah, I was about to say.
It's gone vertical. And, we know who buys that. It's not the average little investor. It's a big blue chip asset manager who's not going to buy junior miners, So anyway, that's the game that's going on. I think it's about to get real noisy.
About to, in terms of weeks, months?
Over the next several months, yeah. I think starting now, I think you get gold, for example. Now, remember, silver and miners have already taken out those highs of the last, since April. Okay. But you get gold back up to 34.50 3,500 again, back to the highs, the price guys are going to give up. And every single time you showed those plateaued regions, the last several years where it goes up plateaus, you hear this hue and cry out there. Oh, it's topping. Oh, it's got to correct back to the last high. Like right now, we got to go to 2,800, or we got to drop back to 3,000. And they've had 4.5 months to do that, and yet they can't do it. So why don't they just shut up? Okay, don't they realize that something's going on here? It's not a normal. You got to correct back to the last high story. So no doubt, if you're listening to that stuff, you've gotten out 5 times in the last year of your goal position. And so at some point, you had to get back in, either at a higher level, or if you're lucky, at the same level. But it's not happening. Gold is not topping. And when you get back up, probably another $50 above where you are now, that's when people are going to realize, golly, it's not going to correct. It's going for more. And another flow of capital will come in. This time, I think it'll be far more accelerated.
Beyond cyclical gains, a deeper narrative is emerging, monetary metals stepping back into the mainstream. With global debt rising and fiat systems increasingly strained, investors and central banks are returning to gold's reliability. Investment flows into gold, particularly from institutional buyers, reflect its evolving role as a systemic stabilizer, not just a speculative hedge.
When you buy a market, first off, it's a global. I made comments in the weekend report about this situation. Copper is in a bull trend. If you go back further and you're showing there, you'll see it's in a price bull trend. It's obvious. Momentum already said a long time ago, you're in a bull trend. Okay. The 2011 highs have been nipped out a year or so ago, pulled back, taken out again. But then recently we had this newsy tariff-related stuff, just like it's impacting the stock market. First off, there's far bigger fundamentals in play out there than this come-and-go tariff news. Okay. Yeah, it could be a factor in play that might hurt certain industries in the U.S. market, but we've already got a stock market bubble that's going to break anyway. And regardless of what the new news might be, it's going to top out and break because of errors compounded over 15 years. Well, the same is true with commodities. They've been advancing for years here, especially look at copper. Platinum's recently joined in, and I think the Bloomberg's about to join in. But the point being that these moves in copper, it's a global core commodity. If one country, even the U.S., puts tariffs on it or doesn't put tariffs on it, that's really not going to change the global supply-demand situation. It might change our pricing a bit, but it's not going to suddenly cut into global demand or cut into global supply. It's going to cause some speculators to have bought and now to have to dump. But that's because they chase news. Forget that kind of news. Instead, look at the broader picture. This recent upturn in copper is not something new. It got well over 5 months ago. In fact, it got up to 5 a couple years ago. So getting up here was not a function of tariffs or not tariffs. So to confuse current action with that. Now, I will say this, on annual momentum of copper, which is in a positive trend, regardless of what the trend lines you want to plot on price chart, which you've got one there that was broken at one point and then it got back above it. But annual momentum says unless you get back under $4 on copper and close a month out credibly back below 4, this uptrend in copper is ongoing. And all this is a drop within the context of the uptrend. And so as you get down in the lower 4s, like 430, 440, you're probably nearing support. And it wouldn't surprise me that it just shrugs off this negative news and starts to inch its way back up again. You can see a headline event there, one day, okay?
Right.
It's ridiculous. Yeah, markets don't fundamentally change like that, especially based on a variable that really doesn't change global supply demand.
Looking ahead, these trends may converge into a compelling macro cycle. Copper continues its steady climb, silver may be poised for its breakout, gold is already breaking its own records. Muted policy, geopolitical instability, and unsustainable debt levels could accelerate flows into metals. When institutional awareness catches up, Precious and industrial metals may solidify as cornerstones of a new metal-anchored investment era. The quiet uprising may soon become impossible to ignore.
So put that in context. And the other lesson from this is don't chase headline news. Just like selling the stock market in April. And we got bearish in January before the tariff news ever got to front and forth center. It wasn't really until you got into late March before the tariff news started to hit. Well, if you finally sold the S&P instead of in January, the first week of January when we said get out, if instead you sold in late March, you got killed. Yeah, you made some money for a few weeks, but ultimately the news flipped. Trump put on his 90-day delay, all these things. And you got killed selling news because the news went the other way. Best thing to do, ignore the news. Focus on the macro trends and assume that headlines like that, which will come and go, are simply come and go things. They don't really change the major trend. And so fortunately, the stock market has shrugged that trade news off, tariff news, made a marginal new high and said, okay, I don't care about that anymore. Everything's good. So let's assume that all the tariff stuff sort of settles down now. That would be an optimal time where you can't really pin it to tariffs anymore. They're known, let's say, at a certain level. And the market then goes down without a headline. That's the way bear trends begin. Later on, you're going to get headlines, and highly likely they're going to be financial market related, commercial real estate related. Little to do with tariffs, okay? Having to do mainly with the level of interest rates that have prevailed for 3 years on the long end, choking many companies that nobody's looking at, commercial real estate, for example. If you'll punch up an RWR chart, you'll see what I mean. This is large commercial, this is not mortgage stuff. These are shopping centers, companies that build computer complexes for industry. Corporate type buildings, okay? RWR, go back a couple years, look back to 2021. You made your high in 2022, okay? Look at that, okay? That's when the S&P made a high at 4,800 and then went and made new highs. Look what happened to commercial real estate. It dropped just like the S&P into 2022, 23, then came back up with the S&P to the late 25 level, early 2025, and didn't make a new high. Instead, it's where it was in 2019. So you could go back even further. There's a decade of nothing here.
Yep.
With a false breakout to a new high in 2022 that it can't seem to regain